Mike, I see a massive polarity in the equity markets right now. It's a select group of haves and everybody else dragging along looking for the next narrative. Am I right on that polarity?
Yeah, that's right, Tom. I mean, you guys were talking about the bond market's volatility here recently. We've been focused on that too. We think that the bond market is sort of jumping ahead of what the Fed is saying, and that's the first time we've really seen that in quite a while. Meaning that the bond market is somewhat, dismissing the Fed's dot plot, which I find interesting because I think the equity market may start to do that too, and it's already happening under the surface, as you alluded to. Meaning small cap stocks and anything that's sort of viewed as lower quality or will have
Right.
challenging with needs capital availability is being punished, and then we're left with 20 stocks kind of carrying the day.
I mean, the 20 stocks carrying the day screams the roll-up I've been talking about for 6, 7, 8 months with the interest rate regime that you studied at Michigan a few years back. With that said, is it a return to what you and I knew years ago, or is this a new higher interest rate regime for the stock market?
Well, I think it's a little bit of both. I think what it really is it's just a much less predictable world. And this has been our theme for the last couple of years, is that we're entering a period of higher economic volatility, right? The last 20 years has been a world of repression where, all of these metrics were somewhat predictable. And that's for companies, that's for the Fed itself, that's for investors. And now we're entering a world where it's just not as predictable. And that means higher risk premiums, whether we're talking about credit, whether we're talking about term premium in the bond market, or we're talking about equity risk premium. In our view, I think people are operating as if we're going to go back to that predictable world, and that's, I think, misplaced.
A lot of people have been reading your prognostications of lower earning multiples for week after week after week. The latest from you, given the events of the past few weeks, we think guidance is looking more and more unrealistic, and equity markets are at greater risk of pricing in much lower estimates ahead of any hard data changes. Mike, given that you've been saying this for a while, and given the fact that we have continued to see resilience in equities that refuse to go down, how do you push back and say, you guys are going to wake up? It might not be yet, even if we get disappointing earnings, but you will.
Well, look, we try to navigate that inside the equity market, right? So, last year we saw a pretty big degradation in multiples, but as we pointed out again today, all that was due to higher interest rates. None of it was due to higher risk premium, which is the part of the multiple that is, pricing in what growth is going to be. Now, I would push back on the pushback, which is that the market is starting to revalue or devalue what I would say the companies that are most at risk of missing estimates. As I mentioned earlier, lower quality companies, more cyclical companies, smaller cap companies that are going to have a hard time with what's going on in the regional banking system. So it is happening. It's just it takes a little bit longer, and everybody kind of focuses on the S&P 500 or maybe NASDAQ 100 as these kind of bastions of safety. And that's true until it's not.
Well, okay, so let's talk about the repricing. Last year we were talking about big tech. And this year the repricing has been in the opposite direction. I'm looking right now at Meta, Facebook, shares up more than 71% so far year to date. Apple shares up more than 20%. Basically, pick your poison, and it's up dramatically. How do you push back against this, against the recovery and some of the names that supposedly were going to come under pressure in a higher rate world?
Well, I think you said it right. These companies took their punishment last year because they were, probably the tip of the spear in terms of, valuations out of bounds. So when rates went up, they took it first. And you could argue that a lot of those groups or, stocks and sectors that they're in are in a recession already, right? That's the area we are seeing layoffs. That's the area we are seeing retrenchment on costs. And I think the debate now, Lisa, is have those companies cut costs and gotten in front of it enough where they can now see earnings growth again. I think there's some appetite for that view. That's not our view. Our view is that there's going to probably be more cost cutting in that space because the malinvestment was just so egregious and the over-earning was even worse. So I think it's just going to be kind of a drip, drip, drip. My suspicion is markets tend to figure this out ahead of the actual numbers coming down. And because the bond market just repriced itself overnight, we think that risk for the equity market is elevated now more than it's been for the last 6 or 12 months.
Mike, you've been labeled a bear, and I know what it is to be labeled a bear, and then people think that everything that you say is bearish no matter what. I'm just saying, even when potentially you do get constructive, Are there any areas that you think have sufficiently repriced where you're starting to see opportunity?
Well, look, I mean, financials have started to reprice in a meaningful way. Not all of these companies are going to have problems, that we're seeing in some of these. So, yeah, I think it's happening. I mean, the other thing I would just point out is that, financials tend to lead the overall market, but that's one area for sure. Some of the retail, some of the consumer areas have repriced. They've been repricing for years. We just added a name to our fresh money buy list today as a retailer. So, I think there are definitely areas. I mean, markets go through these periods with, I call it a rolling bear market, rolling recession. We've kind of, I think, came out with that view a few years ago. Now people have used it, but that's the way it works. And we're looking for opportunities now at the stock level, but at the index level, it just does not look attractive to us.
Mike Wilson, the thing that's different this time around is the pile of money in what's called private equity. Private markets, can they be a catalyst for not like Milken years ago, but can they be a catalyst for a roll-up of all these troubled companies?
Well, look, I mean, first of all, I don't think there's that many, troubled companies. I think we have a situation where valuations are out of bounds, and we need to correct that. I absolutely think there's tons of cash out there where there's private or public money, public money, meaning asset owners that can come in at the right price, and it will. So whatever we're going to get here in the next 3 to 6 months in terms of finally resetting the valuation appropriately, getting estimates down, I don't think we're going to stay at very, very low price levels for a very long time. We're not in the camp that we're in a secular structural bear market. This is a cyclical bear market. It has some completion to it. And your question is really around, is there enough cash and investable funds out there to kind of, stabilize things? And I think the answer is absolutely yes.